Something unusual is happening in the global silver market. A metal that many people only connect with jewelry and investments has suddenly become the focus of a much bigger economic conversation. Silver has always been considered valuable, but today its importance goes far beyond traditional uses. Modern industries depend heavily on silver because of its unique properties. Solar panels, electronics, advanced technology, and many industrial systems require silver to function efficiently. The reason this matters now is because China, one of the biggest players in the global metal supply chain, has introduced new controls that could change how silver moves around the world. An export control means a government decides that certain products cannot freely leave the country without approval. It does not always mean a complete ban, but it gives the government more power over how much can be exported, when it can be exported, and who can receive it. For normal goods, this type of decision may not create a major reaction. But when the resource is something as important as silver, even small restrictions can create pressure across global markets. China's role in the silver industry makes this situation more interesting. The country has a massive mining, refining, and manufacturing system, which means Chinese silver is connected to many international supply chains. When a major supplier changes the way it handles an important resource, the effects can spread far beyond its borders. It is similar to a major highway being partially closed. Cars can still move, but traffic becomes slower, costs increase, and everyone starts looking for alternatives. The global silver market was already facing challenges before this change. Demand has been growing because industries are expanding, especially renewable energy and technology sectors. At the same time, increasing silver production is not something that can happen overnight. Unlike some resources, silver supply cannot simply increase because prices rise. A large amount of silver comes as a secondary product from mines that primarily focus on other metals like copper, zinc, and lead. Creating more silver often requires expanding entire mining operations, which can take years. This is why any disruption in supply becomes important. History has shown similar situations before. When China placed restrictions on certain rare earth materials, companies around the world became concerned because those materials were essential for technology and manufacturing. The situation with silver is different, but the lesson remains the same. When a country controls a key resource, global markets pay close attention because supply chains depend on stability. And now, the biggest question is not only what China has changed. The bigger question is what happens next if global silver supply becomes tighter. To understand why this situation is getting so much attention, we need to look at how the global silver market actually works behind the scenes. Silver is one of those metals where demand and supply are already very close to each other. In simple terms, the world is not producing a large extra cushion of silver every year. What is mined and recycled is often just enough to meet growing industrial and investment demand. The challenge starts when demand keeps rising faster than new supply can respond. Industries like solar energy, electric vehicles, and electronics are using more silver than ever before. At the same time, new mining projects are not coming online quickly enough to balance this growth. This creates a situation where even a small disruption in supply flow can have a larger impact than expected. China's role becomes important here because a significant part of global silver production and refining is connected to its industrial system. A portion of this supply is also part of international trade routes, which helps balance shortages in different regions of the world. When that flow becomes restricted or uncertain, it does not just affect one country. It affects the entire balancing mechanism of the global market. To understand this better, imagine a water system where multiple pipes are feeding a large tank. If one of the major pipes starts slowing down, the tank does not immediately empty, but the pressure inside the system changes. Other pipes have to work harder, and the flow becomes uneven. That is similar to what happens in commodity markets. On top of that, silver markets already operate under what is known as a structural deficit situation in some years. This means that global demand is slightly higher than newly available supply, and the gap is usually covered through existing stockpiles or inventories. But inventories are not unlimited. They act like a backup reserve. When those reserves start reducing, the market becomes more sensitive to any new disruption. This is where traders, institutions, and industrial buyers start paying closer attention because supply stability becomes just as important as price. Even small changes in export rules or shipping flows can influence sentiment in the market. Sometimes it is not the actual shortage that creates movement first, but the expectation of a shortage. Markets often react faster to future risk than present reality. So when a major supplier like China introduces tighter control over exports, the market does not only look at current numbers. It starts to calculate what might happen if that supply becomes harder to access over time. And that is where concern begins to build in global discussions around silver. To really understand why this situation is being discussed so widely, we need to look at how silver is traded on a global level, because most people only see the price on a screen, not the system behind it. Silver does not just move as physical metal from one country to another. A large part of global trading happens through financial exchanges like COMEX, where contracts are bought and sold based on future delivery. In simple terms, many investors are not holding actual silver, but agreements that represent silver. This creates two layers of the market. One layer is physical silver, which is the actual metal used in industries. The other layer is paper-based trading, which represents price speculation and financial positioning. The tension begins when physical supply starts to feel tight, while paper contracts remain large in volume. If the market suddenly needs more physical delivery than what is easily available, pressure builds between the two systems. In such situations, inventories held in vaults become extremely important. These inventories act as a bridge between paper contracts and real-world delivery. When stock levels are stable, the system runs smoothly. But when inventories start declining, the balance becomes more sensitive. Even small changes in inflows or outflows can start influencing market sentiment because traders begin to watch whether available physical silver can meet future delivery needs. This is why supply flow from major producers is always closely monitored by institutions. It is not only about current production, but also about how stable that production remains over time. Now, when we connect this to China's position, the discussion becomes more strategic. China is not only a producer of silver, but also a country that manages resources with long-term industrial planning in mind. That means decisions are often linked to broader economic and supply security priorities. Some analysts believe that when countries adjust export policies on key resources, it is usually connected to securing domestic supply first before allowing external distribution. Others argue that it is simply part of regulatory tightening and administrative control over sensitive commodities. Both interpretations exist in global discussions, and neither can be confirmed without official long-term data. A useful historical comparison is the rare earth situation. In that case, export restrictions led to significant changes in global supply chains, and industries outside China had to adjust to higher costs and limited availability. The important lesson from that example is not the exact outcome, but how quickly markets can adapt when a dominant supplier changes rules. Silver is different in structure, but the idea of dependency on a major supply source creates similar tension in markets. At the same time, it is important to understand that markets do not move on one factor alone. Prices and supply reactions depend on multiple forces working together, including mining output, recycling rates, industrial demand, and investor behavior. So while China's policy shift is being widely discussed, the actual impact will depend on how all these factors adjust over time. When we step back and look at the bigger picture, The most important thing to understand is that global commodity markets do not move in a straight line. They adjust, react, and rebalance over time based on supply, demand, and policy changes happening across different regions of the world. If export restrictions or tighter controls continue, the immediate effect is usually uncertainty. Markets do not like uncertainty because industries depend on stable and predictable supply chains. When that stability feels weaker, pricing tends to react faster than physical shortages actually appear. At the same time, global silver supply does have adjustment mechanisms. If prices stay higher for a longer period, it encourages more recycling, increases interest in previously unprofitable mines, and pushes industries to use silver more efficiently. But these responses take time, sometimes months or even years, not weeks. This time gap between disruption and adjustment is where most of the market attention is focused. Some analysts believe that tighter export policies from major producers could gradually reshape how silver flows between countries, making supply chains more regional rather than fully global. Others believe that markets will eventually stabilize once alternative supply sources and recycling increase. Both outcomes are possible, but the timing of adjustment is the key factor. In the short term, markets often react emotionally before they react logically. Traders and institutions start adjusting positions based on expectations, not just confirmed data. This is why even rumors or policy announcements can sometimes create strong price movement. In the long run, however, physical supply and industrial demand always bring the market back toward balance. If demand continues growing due to technology and renewable energy expansion, silver will remain under structural pressure, regardless of short-term fluctuations. So the real question is not only what one country decides, but how the entire global system adapts to changing supply conditions. And that is why this topic has become so widely discussed among analysts, traders, and industry observers. Because silver is no longer just a metal traded in markets. It has become a critical input for the future of technology, energy, and global industry. And whenever a resource reaches that level of importance, even small changes in supply policy can be felt across the entire world economy.